Welcome to the show where we dig into the most pressing questions facing Canadian real estate. If you are a homeowner, a hopeful buyer, or an investor, you've undoubtedly been watching the market with bated breath, wondering how long will this downturn truly last? What does it mean for the value of your property or your ability to finally get into the market? Today, we're cutting through the noise to bring you the clearest picture yet of Canada's housing future. And then we'll zoom in on what's happening in one of its most dynamic and at times perplexing markets, Vancouver, British Columbia. Stick with me because the insights we're sharing could be critical for your next real estate decision. Let's start with the big picture. Canada's real estate market. It's human nature to look to the past for clues about the future, and a recent report from BMO Capital Markets has offered a stark comparison. They've lined up today's Canadian housing correction with one of the most infamous housing crashes in modern history. The U.S. meltdown of 2007, often referred to as the global financial crisis. And their message is clear. This isn't just a short-term blip. BMO's senior economist Robert Kafzik, who I apologize if I'm mispronouncing that name, states bluntly that while many search for bubbles in the equity market, one continues to undo itself as we speak. Canadian real estate. He explains that housing bubbles are only truly confirmed in hindsight, after the air has already come out. And in his view, that's precisely what we've been experiencing since early 2022. The data now undeniably shows that Canadian real estate, particularly in hot markets like Toronto and Vancouver, peaked in 2022. We are now in year 3 of this downward cycle, and the reality check is striking. Ontario home prices have been falling for over 3 years, even with record population growth. Charting this decline, it almost perfectly mirrors the trajectory of the U.S. housing crash that began in 2007. Now, this comparison doesn't mean Canada's banking system or mortgage structure is about to face the same collapse as the U.S. did. We have robust safeguards in place, but it does mean the correction could be prolonged. Kaftik suggests that if prices continue to track this pattern, it could take at least another 5 years for Ontario's market to fully recover. The U.S. crash, while sharper, also reset the market faster, restoring affordability and rebalancing supply and demand. Canada, on the other hand, appears to be on a path of a slower, more drawn-out decline. Looking back at history, it took the U.S. 5 years from peak to trough during the GFC, and then another 5 years to return to those peak prices, a total of a 10-year cycle. Ontario in the 1990s experienced an even more drawn-out correction, taking 7 years peak to trough, and then another 5 years to fully regain prices, leading to a 12-year cycle. We are currently in year 3 of what could be a very long process. BMO doesn't anticipate another boom of the same magnitude anytime soon. The surge in home prices over the past decade was attributed to a perfect storm, a unique combination of peak millennial demand, record immigration, ultra-low interest rates, pandemic, era migration, and speculative psychology. These stars aligned once, pushing prices to historic highs, and according to BMO, recreating those exact conditions is next to impossible. So while many are waiting for one or more rate cuts to reignite the housing market, the bank's view is that this recovery won't be quick or easy. The market still needs time to reset affordability, recalibrate investor expectations, and ultimately relearn what sustainable housing economics truly looks like. If history is any guide, we might be looking at another 7 to 9 years from now for prices to return to their pre-down peaks. This truly feels like a structural shift, and without the economic prowess the U.S. has to deploy. Our recovery is likely to be very slow. This sentiment of a slower market isn't just limited to home sales. Let's look at the rental market across Canada, which is also softening. If you're looking for a new tenant in major cities like Toronto, your offer better be enticing. We're seeing that nearly 2/3 of all purpose-built rental projects are now offering incentives to attract renters. Much like the resale market, landlords are having to undercut or provide bigger concessions. Average asking rents in Canada fell 3.2% year-over-year in September to an average of $2,123, marking the 12th straight month of annual declines. For purpose-built apartments, asking rents were down 2.1% from a year ago, and for condominiums, they fell 3%. Renters in many regions are now seeing the best levels of affordability in 2 years. And in the most expensive markets like Vancouver and Toronto, rents are at their lowest in nearly 4 years. BC and Alberta saw the largest declines in September, with asking rents falling 5.5% year-over-year. This trend means that institutional housing providers, who can often weather these downturns better, are likely to see even more investment properties hitting the market from smaller mom and pop investors, further extending the downturn. Furthermore, we're seeing a significant rise in mortgage delinquencies, particularly for mortgages with loans above $850,000 at origination, which are running at double the Canadian average. This is prevalent in markets like Vancouver, where we're observing foreclosures in the detached market outpacing condos, as many Canadians maxed out their buying power with variable rates and weren't prepared for payments to double. Now, let's talk about the future pipeline of development. One of the most reliable early indicators for where real estate and development markets are headed is what's known as architectural billings. Think about it. Before any building can be constructed, you need permits, and before permits, you need architects to draw the plans. So when architects are busy, it signals a strong pipeline of new projects. When they're not, it's an early warning sign. While we don't have identical data for Canada, the trends we observe look very similar to what's happening in the US. Architecture and development firms in major Canadian markets like Vancouver and Toronto are feeling the pinch. Billings are down, projects are being paused, and layoffs are occurring across the board. The architectural world often gives us a preview of what's coming in construction and development, and right now, that preview is looking quieter than it's been in at least a decade and a half. The writing's on the wall for a significant lack of future major developments in our major metros. This will be fascinating to watch over the next 3 to 5 years. What happens if demand returns and supply is critically low? Now, let's pivot and take a closer look at Vancouver, BC, a market that often operates with its own unique dynamics, yet is deeply impacted by these national trends. What we're seeing in Vancouver is a crystallizing theme, a looming lack of development. While many feel like there are plenty of homes available now, the indicators suggest a very different future for the next 3, 4, or even 5 years. The pre-construction market in Vancouver has been flagged as the biggest risk, largely due to high investor activity, speculation, and prices that became vastly detached from the resale market. Developers took on immense leverage, and as interest rates rose and the market turned, many projects are now defaulting. It's where all the fireworks are, and we've been warning about this for years. Governments may continue to announce targets to increase home building, but the laws of economic gravity suggest that new construction will only continue to fall from here as the real estate cycle plays out. The mainstream media is starting to catch up to this reality. A recent CBC article highlighted the disaster unfolding in Vancouver's pre-construction sector. The president of Rennie Group, the largest pre-sale marketing firm in the city, noted that the amount of developer owned unsold inventory hasn't been this high in 24 years, citing CMHC data. Other private data sources corroborate this. Developers are sitting on a record number of unsold units. Essentially, for new projects to become viable, prices would need to drop by $200 to $300 per second square foot, a Herculean task. While the new housing minister has discussed reducing development fees, many believe this will only be tweaking around the fringes. The market needs a cleanse. Lower interest rates, reduced construction costs, and significant municipal fee reductions. When developers can't sell what's already on their books, why would they launch new projects? This brings us to a stunning statistic. According to MLA, another major pre-sale marketing firm, there have been 0 new housing developments launched in the entire Lower Mainland for the past several months, specifically August and September. Typically, we'd see 8 or 9 projects launched each month. The industry is effectively frozen solid. The only new housing coming to market is what's already under construction and in the pipeline, which will complete over the next 12 to 18 months, arriving at a time when the resale market is already struggling with an abundance of inventory. Speaking of the resale market, Greater Vancouver currently has over 8.5 months of inventory for sale. This is the highest level we've seen since the depths of the pandemic in April 2020, when the economy was literally shut down. We're also seeing the lowest sales to active listings ratio in September. Many had hoped that Bank of Canada rate cuts would spur housing demand, but that simply hasn't materialized. Buyers are nervous, investors are absent because the math no longer works, and inventory continues to grow at a faster pace than sales. This continued growth in inventory is putting significant downward pressure on prices, leading to effective price declines month after month. It's important to look beyond official price metrics, which can be misleading. What we're seeing on the ground is that only the most attractive move-in ready listings, the good stuff, are selling, often with negotiations. Everything else, such as homes needing major renovations or generic condo units, is simply sitting, going no bid. If a property doesn't sell, it doesn't enter the sales data, thus not fully impacting the average or median sale prices. This means much of the current inventory is either top tier or requires significant price concessions to move. In terms of local policy, Vancouver City Council recently made a bold and somewhat controversial move, approving a 0% property tax increase for 2026. This is a significant shift, especially considering city staff had earlier recommended a 6 to 7% hike. While politically a win for Mayor Ken Sim, who framed it as easing financial pressure on residents and small businesses, it raises economic questions about maintaining services and infrastructure without increased revenue, particularly after Vancouver has seen cumulative property tax increases of about 32% over the past 5 years. And on the high end of the market, False Creek recently saw a record-setting sale, a magnificent penthouse in the Tesoro building, spanning over 50 square feet, with 360-degree waterfront views, sold for $15.5 million. This was the highest sale ever recorded in False Creek, eclipsing the previous record by a staggering 44%. In fact, we are extremely proud to share that we represented the buyer of this truly magnificent home. So, what does this all mean for you? The outlook for the Canadian, and particularly the Vancouver, real estate market is one of a prolonged bear market. Clearing 8.5 months of inventory will take time, and it won't happen during the depths of winter. While predicting the exact timing is impossible, we are now over 3 years into this correction, with a potential shift in sentiment perhaps emerging in the spring of 2026. For home sellers, This means you need to get ahead of the curve. Don't wait for others to set lower benchmarks in your building or neighborhood. Be proactive in your pricing strategy. For buyers, these conditions represent a rare opportunity. 8+ months of inventory and the prevailing sentiment that things will get worse gives you significant leverage in negotiations. You can go in today and negotiate for future price declines, locking in value in a market where sellers know the momentum is not in their favor. Fixed rates, for instance, have remained relatively stable, hovering around 3.99% in many cases. Whether you're navigating the complexities of selling in a shifting market, or you're a savvy buyer ready to capitalize on these unique conditions, having an expert guide is more crucial than ever. Our team has the deep market insight and negotiation expertise to help you make informed decisions, whether you're looking to buy your first home, sell an existing property, or invest in Vancouver's unique landscape. We understand the nuances of this market, from the macroeconomic shifts across Canada to the specific dynamics here in Vancouver, including the opportunities presented by this sustained buyer's market. Don't leave your biggest investment to chance. Call me today for a personalized consultation to discuss your real estate goals. Let us help you unlock the true potential of your property, or find that perfect home amidst today's changing tides. The market is speaking, and we're here to translate it for you.